think we should get started. So good afternoon, everyone. Thank you for joining us on this second edition of the Smart Wealth webinar. This webinar is being held in English, like you can see. We have another format which is being held in Spanish. So if you rather have that version in Spanish, you can go through it in our website. Today's webinar will be dedicated to equities beyond the pandemic. We have a guest speaker who will be sharing his insight with us. The webinar will be split in 3 parts. After this small intro, we will jump into the questions. And afterwards, we will have a Q&A session where you are more than welcome to ask any questions that you think are relevant. And please, we encourage you to do so. It makes the webinar much more interesting for everyone, including for ourselves. So before we jump into the questions, I will just make a brief introduction about ourselves. So Faraday Venture Partners, it's a private investors club. So we give access to private investors to early stage investment in startups. It has no capital commitment, so it's not mandatory to invest in any of the opportunities that we share. Should they decide to invest in any opportunity, the minimum ticket is 2,000 euros, so it's pretty accessible. And this way, any club member gets to build his own portfolio as he or she sees fit. We are also a traditional VC fund manager. Actually, we are raising a VC fund. We have special terms and conditions for those who join us during the first closing. We also have very attractive incentives for those who decide to distribute our fund. So if you have any questions or interests in any of these models, just feel free to reach out, and we will be more than happy to let you know the advantages of each of the models. So today we have Pedro Baldaia as our guest speaker to share his insights with us. Pedro is a partner and a fund manager at LBV Asset Management. Pedro, thank you very much for accepting our invitation. It's an honor to have you here. So before we jump into the questions themselves, could you please introduce yourselves and let us know a little bit about yourself and your background?
Well, thank you, Pedro. It's a pleasure to be here. So hello to all, and thank you very much for joining. My name is Pedro Baldaia. I've worked on equity portfolio management for a little over 20 years now. I did that at very different business settings, at the asset management team of BPI, also at the largest Portuguese family office, and for the last 8 years, being a partner of an independent asset manager, first in Brazil and now in the UK. So this is what I do now. I'm a partner and portfolio manager at LBV. In the past, I looked at global equities, but for the last 5 years or so at LBV, I focused definitely on European equities, especially within the small and mid-cap spectrum. I'm a fundamental analyst with a tilt towards top-down perspective and growth at a reasonable price. I often engage with management of the companies I cover, which I found to be one of the most interesting things of my job. Also a little bit about my background. I graduated from the University of Porto in economics. Then I took my MBA at INSEAD back in 2003. And in fact, given today's topic, bear in mind that 2003 was the year of SARS. So I actually lived in Singapore throughout SARS. And most important of all, of course, I am a CFA charter holder. In fact, recently I also took my ESG qualification granted by CFA UK, and I certainly plan to focus more and more on integrating ESG as part of my stock picking process.
Mm-hmm. We'll get into that later. So thank you very much for the intro, Pedro. So we'll just jump into the questions and to the first question. Could you please summarize the main impacts that the pandemic had on the financial markets, and particularly on the main indexes, and just your thoughts on the evolution on the market since then?
Yeah, I would generally divide the trajectory of the market, of the equity market, since the beginning of the crisis in 4 stages. The first stage was obviously the market crash itself. Stock 600 lost almost 40%, from mid-February to mid-March, and most global indices experienced similar declines in that period. In hindsight, this essentially reflected sudden awareness that the COVID-19 pandemic would have a massive impact in the main economies. And most importantly, it reflected, in my opinion, the realization that there was going to be an extreme level of uncertainty about key data. First of all, what would be the future infection numbers of the pandemic? Number two, what would be the actual impact of the pandemic on the real economy? And number three, what would be the exact impact on company earnings, and ultimately how we should value the equity market under those circumstances. So there was a lot of uncertainty at that moment, and given this was very sudden, there was also something very unique about the market reaction, which was its speed. The market went from its highs to its lows in about 1 month. And this compares, put you into context, it compares with the nearly 18 months for the movement between the high and the low during the 2008 global financial crisis. It was extremely fast. So that was the first stage. And then the market bottomed out around mid-March. On that second stage, what we saw was a strong rebound and a significant divergence of industry performance. So that was even called a K-shaped recovery. In fact, the market kind of took a deep breath and understood that there were sectors whose business was relatively immune to the pandemic, and in some cases it would even benefit from it. So those sectors clearly started to outperform, in particular technology, whereas many others fell behind. Around late April or May, the momentum of those relative winners from stage 2 began to fade out. And then a third stage started where leadership clearly shifted. And instead we saw the most heavily hit sectors by the pandemic outperforming. On the back of the view that those businesses would at some point recover and that it would be a good time now for doing some bargain hunting. Here maybe I'll make a side comment.
Sure.
Currently, and by currently I mean in recent years, the equity market has been kind of an earnings momentum driven market. What do I mean by that? The market is much more driven by short-term news flow, by the direction of travel. That means, to give you a crude example, if I have 2 companies that are peers, one is trading at, let's say, 20 times PE, the other one at 10 times PE. But if the more expensive one comes up with good news and the cheaper one with bad news, the more expensive one will still outperform the cheaper one, will become even more expensive in relative terms, regardless of the previous relative valuation. It's a bit of a generalization, but you will see my point. Why is this relevant? Well, what happened during stage 1, so the crash, was a huge debasing of earnings estimates for most of the listed companies. Sometimes you could not even see that on consensus numbers because analysts were too slow to update their numbers, but everybody was assuming the worst. But then during stage 2 and 3, you started to see 2 things taking place. First, the market started to understand that yes, earnings would be bad, but often not as bad as feared. In fact, often company business models proved to be more resilient than feared. And also costs were lower, be it due to lower travel expenses, or due to several types of government support. And even more importantly, the market realized that maybe Q2 could be regarded as a one-off and as an earnings trough, and things would improve from then on in terms of earnings, in some cases dramatically. So there will be material sequential earnings growth from Q2 into Q3 and afterwards. And so it will be much wiser as well to base equity valuations not on those depressed 2020 earnings, but instead on a new normal, say on 2021 or 2022 numbers. And for those, you had kind of a 2019 reference to guide you. So that, voila, earnings momentum turned positive starting in Q3, and valuations suddenly looked attractive again. And the market, being earnings momentum driven, coming back to my previous side comment, rallied sharply for a number of months. Now, for a number of months, we have been at what I would call stage 4, perhaps over the last 4 months, where we see that the market quickly oscillates between short-term optimism and pessimism on the back of economic news, pandemic news, earnings news, or other, but with much lower volatility than on the previous 3 stages. On the other hand, the market is not that far from historical highs, which still feels uncomfortable for many investors because it seems inconsistent with the ongoing threats for the health of the global economy. There is clearly more of a wait-and-see attitude. The market's waiting for news that give more visibility on how 2021 and 2022 will unfold. When it comes to the economy, when it comes to health, and ultimately when it comes to earnings. So that's where we are right now.
That's interesting. That's interesting. So moving to the next question, we have seen different indexes reacting in different ways to the pandemic, and especially when you compare the US with Europe. And going back to your previous comment on the industries, for instance, Nasdaq has recovered way faster than other indexes. What do you think are the main drivers for these different reactions in the indexes? And in the case of the Nasdaq, do you think it could be industry related, as you mentioned before?
So in the very beginning of the pandemic, actually relative performance was much more a function of the regional spread of the virus. So as we all know, the pandemic started in China, and in February, at some point, the local index, the Shanghai Composite, was down by about 15%. Even if the Western world, the indices were still close to their highs. At that point, the dominant view in Europe and in the US was that COVID-19 would be more of an Asian issue than a global one, similar to SARS. And to be honest, I thought the same myself. As I said,
I think most people did at the beginning.
But you know, on top of that, because I lived in Singapore in 2003 and I experienced it closely, and I experienced how it was eventually sorted out. Maybe I dismissed as well COVID-19 as a temporary hiccup, similar to SARS back then. But then the virus obviously started to spread from east to west, and the same happened with market declines. As you know, the recovery from the pandemic to this point has been much more effective in Asia. And this is also reflected on the stock market. We currently have China up about 10% on the year. Europe is down a little bit more than 10%, and the US is barely positive, so a different performance. But clearly, over the last 6 months or so, within the Western world, the major difference in performance was related to sectors. And the different weights of different sectors on the indexes of each geography. So the clear standout of that stage 2 of the trajectory that I previously mentioned, so those sectors for which the pandemic can be seen as a tailwind, is technology. The technology sector makes up about 30% of the S&P 500 compared to about 10% in the Stock 600. And the technology sector in the US is up about 30%, I think, year to date. So this difference in weight on the index alone justifies the outperformance of the US index versus Europe since the beginning of the year.
Yeah, due to the industries.
Yeah.
Yeah. Okay. And do you think there are still interesting opportunities in equities, or are there any cautions that should be taken? Any protection strategies that could be carried out either through other financial instruments or to redesign the asset allocation?
Well, yeah. So I started working with equities back in 1999. So I've been through 3 major crises. And what I understood is that in the long term, you make money in equities, but timing is obviously somewhat important. But that also at any given situation, at any given moment, you can find interesting opportunities in equities, and equities should definitely be a part of every investor's asset allocation. Are equities now more attractive than what they historically have been? I would say probably not. So as always, you should proceed with some caution. So a little bit on the drivers now, especially in terms of macro. It is clear that economic numbers have been improving in recent months. So business confidence recovered. We have PMIs above 50, both in Europe and in the US. Consumer confidence also recovered. You have liquidity improving on the back of support from governments and central banks. So you have some positive drivers. But on the other hand, of course, there are significant risks. And given the ongoing imbalances, you can also argue that maybe this recovery will not last long. Maybe employment will rise significantly, disposable income will decline, the number of bankruptcies will surge, the main economies are heavily indebted, taxes will surely rise. And all of these are important risks, even before assuming any further lockdowns in the main economies. So there are substantial risks. I would say that we're back to that situation where there are 2 scenarios with different probabilities and different payoffs. So most likely the global economy will continue to slowly creep up, but equity returns in that scenario will probably be lower than the potential losses that you might incur in the case of a significant downturn. That said, don't forget that the market is not the economy. And this is something that one always has to point out. The market is composed of some of the largest and most resilient companies in the world that are often global and that usually perform better on their competitive environment than smaller non-listed competitors. And also, due to what we already discussed, depending on what is your view on the economic environment in the future, you can actually tailor your portfolio accordingly in terms of country, origin, or industry. The other driver that I should point out clearly is interest rates and inflation. I continue to be a bear in inflation. I think we've had 2 dominant deflationary themes in the last maybe 20 years that are still valid. Due to these, which are due to the digital disruption, you have a global goods market, so you have better visibility of prices, and you have a global supply chain. This allows for more efficient allocation of cheaper resources on a global basis. And additionally, in the past, there was always the threat of rising commodity prices as a trigger for inflation as the economy has picked up. But clearly, this was more about oil, the price of oil. And at this point in time, for a number of reasons, in particular the energy transition, I think this risk is much more limited. So even though you do see some increases right now in some agricultural and industrial commodities prices, I would expect inflation to remain low and interest rates to remain low as well. So as long as you believe that indeed interest rates will be close to 0 for the foreseeable future, it all boils down to a lack of attractive investment alternatives to equities. I usually say that equities are at least the least unattractive asset class at this moment, and probably continue to be. You mentioned protecting your portfolio. I'm not too fond of specific protections because usually, unless you believe that you can get your timing right, which is difficult, you will tend to incur in recurring losses with the rollover of those protection mechanisms. I think if you want to be more conservative on your portfolio, you may want to diversify more and add other asset classes. So yeah. And also, just maybe one point which I think is relevant in terms of designing your equity portfolio at this moment. I think that there are trends that are have been very clear this year, should continue to be so. One is the importance of earnings momentum, as discussed before. The other one, which I think is very interesting under this environment, is the outperformance of quality stocks. So what are quality stocks? So this definition is always very dubious, but these are usually large caps with well-known brands and proven business models that typically exhibit low earnings volatility. So in an environment of uncertainty and volatility, many managers clearly gravitated towards those stocks that they think they can easily justify to their bosses or to their clients if things go wrong. So yeah, that's how it works. So you end up buying stocks that are trading at maybe 1 or 2% free cash flow yield, so very low, very high valuations, very low returns, but with 0% interest rates. There are many people that still believe that those valuations can be justified. So it has worked. I prefer to look at stuff that has more interesting valuations, but it has worked so far. And the other topic is clearly ESG. Again, touching on ESG, I cannot stress enough how this topic is gaining awareness on a global basis, even more so in Europe, to be honest. More and more investors are integrating it on their stock picking process, and more companies are publishing detailed information and developing significant efforts to comply with investor demands. And I also cannot stress more either how this topic is pretty much misunderstood by many people. In particular, many people still don't get it that ESG is usually a win-win. By investing in more sustainable businesses, you are in fact also trying to capture a long-term financial gain. And this year, ESG winners have clearly outperformed ESG losers, and I would expect that to continue. Yeah.
Interesting. That's very interesting. So with that in mind, what do you think are the most likely scenarios as the pandemic fades away, and especially after if we finally have a vaccine? What do you think are the most likely scenarios?
I would say that there are two main question marks. Number one, how serious will the pandemic waves be until we get a vaccine? Mm-hmm. And number two, whether we will in fact get a vaccine. So right now we are definitely experiencing the emergence of a second wave. We all know that. Even though with different characteristics from the first one. As we know, the situation is serious in most regions of the developed world, but clearly not in Asia, at least in China. And this is very important both in terms of global demand and global supply chain because of the current importance of China in the global economy. So this is a clear positive within the full spectrum of bad news. The number of infections, as we know, is higher, but fatalities are lower than the first wave. So there is no certainty if there will be substantial lockdowns, and this is a critical point for GDP numbers going forward. If we do get additional general lockdowns, what would happen? Clearly a market downturn for sure. But my guess is that the impact on the market will not be as serious as the March decline for two reasons. One, the market knows that the development of a successful vaccine may soon be announced, or of many vaccines. And we didn't have this glimmer of hope back in March. So the sheer existence of this positive scenario has to be priced in somehow. And the second one is that the market now has a playbook. Investors now have data on the impact of lockdowns on the economy and on earnings, and they can also go back and check which investments worked and which did not during the previous lockdown, during stage 2 or stage 3 of the trajectory. So compare that to what I mentioned about stage 1, when people had absolutely no idea what was going to happen. So this represents a massive reduction of uncertainty, and in my opinion should be priced in too, so that if the market goes low, it doesn't go as low as before, as on the first wave of the pandemic. Also, the fiscal and monetary authorities have their own playbook as well, and the health authorities have their own playbook as well at this moment. So I think that situation would not be as serious as before. That said, my central scenario continues to be that, yes, there will be lockdowns, but only in specific areas, in specific timeframes. So we will see that muddling through of the economic activity, with the exception of obvious losers in terms of sectors such as commercial real estate or travel and leisure. Those will take longer to recover. And again, the global supply chain holds on, contrary to what happened in many cases in Q2, helped by that relative normality in China. And then, if and when vaccines come to the market, well, first of all, you know that it takes plenty of time to vaccinate the whole population, so there will be kind of a time lag. But I'm pretty sure that we'll see immediately a significant increase in business and consumer confidence. And due to that, most likely an acceleration of global economic growth. And usually the stock market anticipates that. So you could see the market actually, in fact, rallying as soon as we have more news on vaccines. A key question, and this has to be evaluated, I would say, case by case, sector by sector, is for each sector, what is the level of recovery for each sector? How will the new normal look like for each sector in the future compared to what it was in 2019? And the other question, the flip side of that is, for those sectors that thrived during the crisis, again, like digital commerce, what will happen to them? What will be the new pace of growth? Should we expect to see a strong slowdown of their businesses? So there's a number of question marks.
I understand. Thank you. And Pedro, what do you think should be the best sectors or industries to invest in the future?
So, yeah, I'll start with a disclaimer. So I'm a long-term investor. I'm a buy and hold investor. I have a top-down perspective. So I want to invest in companies that have a strong competitive presence in businesses that are exposed to secular growth trends. This is critical to me. we all know many of those trends: the digital revolution, the demographics, the energy transition, more healthy habits of the population, more environmentally friendly products, and so on. With this in mind, in fact, the pandemic did not change too much in terms of my typical sector allocation, apart from one specific sector, aerospace, which was clearly one of my favorite sectors in the past. For obvious reasons, it is significantly down, and until we have more visibility on how it will look like under a new normal, I don't plan to go back to it anytime soon. So this is more of my long-term perspective, but I think it's important on this discussion to discuss one particular point. There's one additional factor which I think that which is a bit shorter term, which I think is critical when managing portfolios, and I will explain why it is increasingly important at this point, which is to look for inflection points for each sector. So look for those moments when there is a significant delta, a significant change, positive or negative, of revenue growth. Because so those moments when things change from bad to less bad, or from good to less good, you know, when trends do change. Why? Because those are usually key moments when those sectors either outperform or underperform strongly. And why am I pointing this out? In my view, this has mattered more during 2020 and will probably continue to, because I expect those inflection points to be more frequent in coming quarters than in the past. And I'll give a few examples because it's similar to what we saw during Q2 and Q3. In Q2, clearly sectors such as, well, I mentioned technology, so I'll mention another one, such as personal hygiene accelerated, whereas most of the others slowed down. So that was in Q2. In Q3, some of the winners of Q2 continued to accelerate, such as technology, but others slow down. So I mentioned personal hygiene. Let me just give you a data point. Apparently, diaper sales in Europe dropped by 7% in Q3. Why? Because there was stockpiling in Q2. That should be the main reason.
Yeah,
on the other hand, out of the Q2 losers, in Q3, many of those recovered strongly, such as a number of industrials. Same for automotive, rebounding strongly in Q3. Whereas, for instance, travel and leisure and commercial real estate continue to be weak. So things are changing very quickly, sector by sector. And this will continue to be very volatile in the near future as you continue to get news about possible lockdowns or get news about possible lingering effects on the economy. And later on, we will probably get new major inflection points when vaccines are introduced. So this is my key message here. There will be, I think, an increased frequency of those inflection points, which results in an increasing complexity of the market and of portfolio construction. So it's a level of complexity that, to be honest, I think it has been very uncommon during my 20 years of experience. So maybe I'll just give a few examples on how I see a number of sectors. So I mentioned technology, which I think is a particularly good example because it's a mixed bag, in my opinion. So there's an obvious, take an obvious winner such as digital commerce. Long-term trends are certainly supportive. There's secular growth. in the short term, you have acceleration of growth. But on the other hand, valuations are generally very high too. And how will the market react when the pandemic numbers are reduced, when offline channels start to open up, and maybe that delta of growth becomes negative, so growth starts to become much slower? Will there be a significant negative inflection point? Maybe the market won't react well at that point. Same for video games. Video games is a sector I absolutely love. One of the former biggest winners of my portfolio, they saw their revenues growing more than 50% in Q2. Is that sustainable? Especially, you have to take into a consideration that now valuations on that sector are very high too. So we're talking about 40 times PE maybe. Going into next year, for sure, for these companies, the dominant market comment will be business continues to do well, but comps are now tough. So watch for a negative inflection point. But within tech, then you have a sector that I particularly like, which is telecom networking equipment. So obviously structural growth as well. I mean, you see the flow of 5G contracts that companies like Nokia or Ericsson have been winning recently. IoT will be a driver at some point too. Returns on capital are certainly lower than software players, but valuations are still okay. So maybe something to consider for the future. Same for semiconductors. It has been a strong area, and maybe it will continue to be so, because again, you have exposure to end markets such as telecom networking equipment, but also to others like automotive or smartphones, which have been down recently, but are rebounding, clearly rebounding in Q3. So maybe an interesting sector to look at. So even within each sector, you still find a mixed bag of inflection points. Another one that I might want to mention is infrastructure. So clearly this might be a surprise considering the high levels of public debt in major economies, but there's a clear coordinate push for building infrastructure. So think rail, think renewables. Renewables in particular will continue to be a hot topic. The energy transition is receiving full support from governments, is loved by ESG investors, but pay attention because usually when you go through the supply chain, many of the participants are being squeezed by the operators in order for them to get lower prices. So there's a little bit of margin squeezing. It's not an easy market. The other one, for sure, electrification of vehicles. So anything related to EV and the infrastructure and the technology around EV. Even though for the automotive companies themselves, obviously they will have to invest heavily to develop technology. So cash flow generation will certainly lag for a while. And so that said, again, on automotive, it's interesting that I think I mentioned in the beginning that I typically engage with the companies that I cover, and every single one of them over the last few months have been saying that Q3 has been still down year on year, but clearly better than what they expected at the beginning of the quarter. Yeah, and Q4 apparently is doing well as well. I touched on the fact that when we get the vaccine, maybe we'll see a strong inflection point on the heavily battered sectors. And obviously, then you will have to look at travel and leisure, especially those that still have pristine balance sheets, and in particular aerospace. Some of those high quality names are still trading at depressed levels. I think you will want to look at some of them in a few months' time. Maybe just one more point in terms of inflection points. Yeah, I think another interesting discussion is for each sector, what portion of demand, what was actually destroyed in Q2 versus what portion of demand is actually pent-up demand that will be satisfied as lockdowns are lifted. Obviously, restaurants will not sell in Q4 meals that were not eaten in Q2, right? But on the other hand, think about the medical sector. So any medical company that provides products or services for elective treatments or surgeries that have been postponed, those guys were hurt by that lower demand utilization in Q2 and Q3. But this is pent-up demand that will return at some point. People will still have to have those surgeries. So when you get an inflection point there, it might be quite strong. And finally, in terms of being bear, I'm still a bear in energy and banking, even though valuations are generally low, long-term trends are negative, and I don't see any inflection points ahead. So yeah, bit of a long answer, but yeah.
Okay, thanks. Pedro, you previously mentioned that you integrate ESG criteria in your stock selection process. You want to let us know a little bit more about how is it that you do that?
Sure. So this has been an ongoing process for me. I think first of all, it's important to give a few definitions on exactly what you can do when you integrate ESG and what I do. So first of all, it's very important to distinguish between a responsible investor, a sustainable investor, and an impact investor. I see myself as a sustainable investor, and I will explain why. Both responsible investors and sustainable investors, they understand that the integration of ESG analysis results in a win-win, as I previously said. So sustainable investing goes hand in hand with the promise of a better financial return. As opposed to impact investors who make investment decisions regardless of whether there is a potential financial return. On the other hand, responsible investors are more focused on mitigating risks. So this is identifying risks such as externalities that might have to be internalized, or no respect for labor issues inside the organization, or poor corporate governance, which might have a negative impact on the business in the future. So the action taken by a responsible investor is typically negative screening, that is not investing in non-complying sectors or companies that have lower ratings.
Adverse selection.
Adverse selection. Where the sustainable investor goes a step further and focuses on positive screening, that is identifying opportunities, usually more related to the E or to the S, that could make that sector or that company outperform in the future. Again, I am a top-down investor, and this concept connects quite well with that, because it's a sort of integration in theme investing, which is something that I like, when there is materiality of the topic in the company that I cover. So those themes related to the E would include obviously companies that manufacture environmentally friendly products, whereas in the S, we actually find a number of social topics, such as demographics or the digital disruption. So many of those underlying secular growth trends that I mentioned before, those can actually those fit quite well in an ESG perspective. So this is the type of ESG integration that I plan to do. Being a responsible investor, meaning doing some negative screening, but most of all doing some positive screening.
Understand. Great. Thank you. Thank you for sharing. So this was our last question. We have slightly 15 minutes for Q&A. I can see that some people in the audience already placed some questions. Here they are. So I'm gonna browse through them. Well, the first question is, as a fundamental approach, what are your comments about the liquidity injections makes by central banks? Does this force you to review the concepts of cheap stocks?
Of cheap stocks, you mean?
You can also browse through the questions, Pedro, if you want.
Sure.
If you click on the Q&A, you can also see the questions. Maybe it's easier for you.
I would say that essentially the intervention of fiscal policy and monetary policy has resulted largely in a transfer of wealth to the corporate sector and as such to the biggest companies and to the stock market. So that's clearly my view. All of that at some point will have to be repaid somehow. But I have to say that using the typical time frame that the market uses, that's probably not for the foreseeable future. So the market tends to shrug that impact off to a large extent. So yeah, and in the end you have kind of a central bank put. You know that if you get more negative economic data, you have a good probability that again monetary and fiscal authorities will intervene to support the economy and as such to support to support the stock market. I would say it's generally supportive of cheap companies and also of expensive companies. I would argue that it's even more supportive of expensive companies, as I was mentioning before, when it comes to quality stocks. Again, valuations are extremely high, and I can only justify, or I can only understand that people are buying stocks with free cash flow yields of 1 or 2% if they believe that there is monetary support that will keep interest rates close to 0% for a long time.
Okay, thank you, and thank you to everybody in the audience who is making questions. So it's way better for us to make this as much interactive as we can. So we have another question, which is, what's your economic outlook for Portugal in 2021, and how much do you think that tourism will bounce back in 2021? Of course, this will be extremely related to the pandemic, but what's your thoughts on that? What's your take?
Yeah, so I have more of a broad perspective. To be very frank with you, the Portuguese stock market is relatively small, and even the companies that are present in the stock market, some of them are the ones that interest me the most, are relatively internationalized, so that I don't have a specific view on the economic outlook for Portugal. Obviously, I will give you my general view that taxes will rise, the economy will suffer. If tourism will bounce back in 2021, that clearly depends on the outlook for the pandemic. So it's clearly a function of that. It could bounce back very strongly if we do get a vaccine, and if people become comfortable with traveling again, especially because I believe that once people start to travel, still they will want to travel to closer locations, so locations that are a little bit nearer their homes. So probably Portugal will be again on the list for UK visitors and Scandinavian visitors, as opposed to flying long distance to Southeast Asia or other parts of the world.
Makes sense. You can see the questions, right, Pedro?
Yes. So a point on passive versus active management, which I didn't touch on during my initial remarks, but I think it's a very relevant point at this moment. And again, it's one of the reasons why those quality stocks continue to outperform, because again, they are usually included in the main indexes, and people still have to buy it regardless. There are a number of reasons why active management continues to be threatened, and one of them is exactly that: the fact that those companies that look expensive continue to be more expensive because passive investment continues to grow. So as an active manager myself, I have to believe in my business, and I have to believe that I'm investing in companies that it makes sense to invest regardless of whether they are included in indexes. But this is clearly a significant threat for my particular business.
Okay, thank you. And we do have one more question. Can you see it? You wanna go through that?
Yeah. So that's actually an interesting point.
I'm sorry, Pedro. I'm sorry to interrupt. I'll just say the question so everybody else knows which question is it. So somebody in the audience is asking, in a zero interest rate environment where momentum is destroying value, how defensible is GARP?
Yeah. Again, I think coming back to inflection points, I think you have to be aware of what is the growth outlook for those companies in the long term, but also in the shorter term. So it's defensible if you can defend yourself by understanding also the short-term drivers. So that's exactly a critical point for me. I need to understand if how that second derivative, to what extent there will be an inflection point of growth for those sectors that I'm looking at any given moment. So in case you do have growth, well, momentum helps. So again, it's an earnings momentum driven market. And if you do have growth, the market will push those stocks for sure.
Okay, thank you. So for now, I think, oh yes, we do have one more question. So the question is, what about intangible assets, brand, algorithms, software, users, and so on? This item represents now more than 75% of market value of several companies. Is this a problem to valuations? Will volatility also increase due to these invisible and unpredictable assets?
Absolutely, it is, because those assets or the value of those assets is much more volatile. So what you find on the balance sheet of that being the value of an asset is usually, to put it mildly, subjective. So clearly, it is a problem of value. I would actually say it the other way around. Usually, it's a way to justify valuations, to say that well, the brand is worth X or the algorithm is worth Y. But it's I mean, translating that into a discount cash flow model is more difficult. It depends on a number of assumptions. So it's a highly subjective, and yes, it's a problem. I think volatility for those stocks can definitely be high, continue to be high in the future.
Okay, thank you. And we do have another question just came in. So for a question, first, don't to find quality stocks in the smaller cap spectrum that are less known, offering a long and sustainable runway for growth, and that are trading at reasonable valuation metrics? Can you give examples? And second part of the question, what are the cash flow yields that are you looking for in the current environment, and what type of growth do you see for those yields? And how long is the runway? Third part, are you willing to sacrifice the quality spectrum to get cheaper ideas?
Yeah,
you can see it's a very long question, but yeah, I think you can see it, right?
No, absolutely. So first of all, again, the definition of quality is highly dubious. So as I mentioned, typically people will say that those are large caps. In my view, I focus on small and mid cap spectrum. I find companies that have great quality in the smaller cap spectrum. I just hope that the whole market understands that as well in the future, because in fact, what you continue to see is that larger caps continue to trade at a premium. There are a number of reasons for that. This is a market where the large funds become larger. They don't have the possibility to invest in these smaller caps, whereas the smaller managers have issues with their size, with increasing their assets. So if their assets don't grow, this is a threat for the companies that they can invest in. Same for MiFID II, as we know, which was a reason why research teams in many brokers started to be reduced. And obviously, when coverage is reduced, it starts with the smaller caps. So there's a problem for these companies for being less covered, even though many of them are of extremely good quality. I'm sorry, I will refrain from giving examples because those are typically in my portfolio. So I would refrain from giving stock recommendations. But Pedro, feel free to get in touch in the future and we can discuss that. What are the cash flow yields? So as a ballpark estimate, I typically look for companies that have a minimum of free cash flow yield before expansion capex of 5%, and revenues that grow at least high single digit. So that would be kind of my typical ballpark number. How long is the runway? So I mean, I have to expect that this growth should continue for at least 4 years. Are you willing to sacrifice the quality spectrum to get cheaper ideas? No, absolutely not. Again, even the smaller cap spectrum, I do find many quality ideas, and I'm too cautious about value traps. So definitely not.
Thank you very much for that. We just ran out of time, but we still have one last question. So I think we can squeeze it in if it's okay for you, Pedro.
Well, I just touched on MiFID, yeah. So
yeah,
how significant?
So the question is just let me say the question so everybody is on the same sheet. So as a small mid-cap manager, how significant has been the impact of MiFID II in your ability to source ideas?
Negative impacts for sure, and hopefully at some point regulators understand the damage that they are causing in the market, and this comes essentially from the fact that brokers, as I mentioned before, need to reduce their teams because their revenue streams are decreasing, and they do that by reducing coverage typically of the smaller caps. So those companies, many of them are very valid business models. They just don't have enough coverage. And for smaller managers that cannot work with all the brokers that they would like to, sometimes it's more difficult to get access to research on those interesting ideas. Obviously, then I will do the work by myself, right? I will get in touch with the company and do my own research. But obviously, the process was much more efficient in the past. So clearly, a terrible action from the regulator that causes damage for everybody involved in the investment process.
Mm-hmm. Okay, thank you very much, Pedro. Well, so we just ran out of time. I would like to thank everybody for joining us on this webinar. Like I said at the beginning, this session was and is being recorded. So if you want to go through it again or just share with some friends, please feel free to do so. Pedro, again, thank you very much for accepting the invitation. It's a privilege to have you here. Thank you very much for your insights. And thank you. And if you like to follow more of these webinars, just subscribe on our channel, and we'll be sharing more webinars in the future. Thank you all. Thank you, Pedro.
Thank you. Bye-bye.